Afternoon everyone, welcome back. Today is Friday 13th of March, so we should be right in the middle of the recession. Hopefully this is going to be released on Sunday. It's kind of an emergency episode because we're right in the middle of the market crash at the moment, and I've got a lot of friends all coming to me because they've seen on the news that the stock market's crashed, they've got a bit of spare cash and they want to invest, and they don't know what to invest in. I'm kind of getting fed up of explaining it over and over again, so I think I'm just going to make one big video explaining how funds work and then just send it to them and get them to look at it. So hi anybody who I've just sent this to, it's because I can't be asked to talk to you right now. I think the urgency of this one today is quite important because today the FTSE 100 and the S&P 500 have both rallied a little bit. The FTSE 100 is up by 6%, which is quite good as for a rally. It could mean that we've actually hit the bottom. We don't know that yet though. Also the UK gilts are down, which is the equivalent of the US Treasury bonds. That shows that people are probably trying to get their money out of there and start putting it back into the market. It's very important right now for anybody who's thinking about investing to actually get in the market now. I understand that people don't have the time to look for individual shares and evaluate them, and that's where funds come in. That means today I'm going to do a brief explanation of what all the different types of funds are and the pros and cons of each one. I'm just going to keep it super simple, and at the end I'm just going to show which ones I'm looking at. It's important to learn about funds quickly because if you're going to make some money off this current crash, you're going to have to get in pretty soon. Stocks and shares individually require a lot of evaluation and a lot of time to look into them, and funds will just really diversify your portfolio straight away. Diversification is important because if you've got lots of stocks in different countries and different sectors, if one sector gets damaged or one country gets damaged, you don't completely lose all of your money, and the other side should benefit off that. And everything will even out like the fucking circle of life. First of all, we're going to start with bonds. Bonds I don't really talk about very often because they're not really part of my portfolio. I'm a little bit more aggressive than bonds, and personally with the amount of money that I have, they're not really of any use to me at the moment. Bonds are generally a safe investment that go up very gradually with a pretty poor return in comparison, and what they're important for right now, particularly during this crash, is that they hold their value very, very well in a recession. As someone who's storing their money safe, you're not going to make much growth over time, but you know it's probably not going to lose much value in a really bad time. As a dividend investor, what you can do if you've built up a good 15% in your portfolio is during a bad time, you can sell all those bonds because they won't have depreciated as quick as the other stocks in your portfolio, and you can actually start to reinvest in the dip of that portfolio. That's kind of how you want to do it as a dividend investor. If you're just looking for safety, bonds are where you need to be. The only bond I really use in the UK right now is premium bonds. I have a small couple of grand emergency fund which is probably going to get dumped into this market pretty soon anyway, and that's just for the future, just in case I lose my job or something for a month. I can get, I can survive for a month. They're the only bonds that I actually own. I have got the iShares Core UK Gilts bond that I'm looking at the moment, but that's going to be so far in the future, I just don't know if it's worth investing in just yet. If there's anybody out there who can think of a better use for bonds, then let me know in the comments below. Right now, all I care about is just being quite aggressive with my portfolio, I think. Next up, we have managed funds. Now, I've gone to my very old and lonely Hargreaves and Lansdown account. My Hargreaves and Lansdown account is sitting there with all of the funds that I have left over that haven't made any money. I sold quite a bit, probably 5 grand, which was all in profit and doing really well. And I'm left with the stuff that I'm just stuck with for a long time. Most of them are managed funds. That's not to say managed funds are necessarily bad, because there are a few positives, but for me, I don't want to be anywhere near them. As you can see, we have the Rathbone Global Opportunities, HL Multi-Manager, Global Strategy Adventurous Portfolio, Unicorn Outstanding, and Threadneedle UK. They are my managed funds, and if I'm perfectly honest with you, they've been doing dog shit since I ever got them. The only good one was Rathbone. That's been hit as hard by the market as anyone else. But managed funds are a group of stocks and shares that have been put together, and they are managed by a professional. So there's some guy sitting in some tower somewhere, and he's like picking your stocks for you. And generally he's supposed to be educated and really good at this shit. So he will make you money. The positives to a managed fund are that somebody out there is actively working on your portfolio. They are a trained professional, so they should know what they're doing, and generally they're quite good at diversifying. Actually, a pro for managed funds is that they generally do a bit better in a recession, because you might find that a percentage of your portfolio is weighted towards bonds and treasuries. They might be able to ease the loss for you in a recession. Cons of this, however, are that the fees are stupidly high normally. The cons of the managed funds are mainly that they charge a lot more fees to manage your funds. There is somebody who needs to be paid to do this. Also, these stock markets are supposed to be really unpredictable, and really no one knows what they're doing. There's also a fact out there that something like 90% of managed funds don't beat the index market. So why are we doing it? I don't really know. Also, brokers are assholes. If you've heard about the Neil Woodford scandal, I think the news came out today that everybody who lost money is going to share a 142 million pot. So when these funds collapse, the person that's in charge of them doesn't have any liability towards you. They don't care about you. They are just looking to get their paycheck. As you can probably tell, I'm not a fan of managed funds anymore. I think you can do a better job yourself. And if not, just go into an index, because you're going to do pretty well in there. Which brings me to index funds. Index funds are algorithm driven, which means there's no managers, and they use a mathematical algorithm that is way above my station to pick the best stocks in a certain sector. A good one which I like at the moment is the Legal and General US. I'm pretty sure it tracks the S&P 500. It generally tracks the best companies in the US, and you either do very well when the US economy is doing very well, or you do very poorly when it is. Like now, it's probably seen a 20% drop. So if you're in an index fund right now, you will see their 20% drop too. The pros of an index fund are generally that they've got quite low fees because there's no manager. As you can see, the average annual charge of this one is 0.5%. That's actually very high because I'm with Hargreaves and Lansdown, which is a company that I really can't stand. They've made my life so hard to get out of this, and their app barely works. I'm just not into it at all. But the index funds are very, very good. Another big benefit of the index funds is the diversity. When you put your money into an index fund, you get access to all of the stocks in that index, and you will get all the returns from that index as well, and all the losses. In doing that, you will spread your risk and hopefully not lose as much as you would if you're an idiot like me and picking your own stocks. The cons to these types of index funds is that you still get fees from them. They take the fee out every month, I think it is, and it's 0.5% over every year. They're a little bit boring. You don't really get to choose your own stocks and shares, but you can do a lot of research in them. Hargreaves and Lansdown and Vanguard have very good open sheets and fact sheets about each fund, and it tells you everything you need to know. My one gripe with these ones in Hargreaves and Lansdown is they calculate daily. So where it says I'm down £716, that is not actually what I'm down right now. It will recalculate at about 11:30 at night, and then I've got to choose whether I'm going to sell it at 11:30 at night or not. This is the toss-up between whether I'm a long-term investor. That shouldn't matter to me because I should be way in the black, and it shouldn't matter to me at all. But right now, when I've made a mistake and I've accidentally invested into some stuff that I didn't want to, there's no way I can sell it right now because I don't know what the price is going to be in the morning when it comes to sell. What I've now decided to go with is ETFs. Now, ETFs are still index funds, but they are exchange traded, which means you trade them as you would like a stock. They do exactly the same thing. The fees are exactly the same, but the fees are built into the price, so you don't actually get it taken off your money. The price you look at is the price you pay with the fee built in. You can also sell them whenever you like. You can sell them straight away. If you've put money into a fund that you find out some new information about, or it changes quicker than you think, you can get it out immediately. And me doing this channel and doing all this movement all the time, I kind of like that idea. I just like to have that freedom. It's just nice for me to know. They're also the main type of fund on Trading 212, and I like to keep my stuff all in place. So Trading 212 is where it's at, and that's where I'm going to buy my funds. The selling straight away thing is also a bit of a con, because you might not want to. It allows you to be a bit too emotional about your investments. So when you start to see it drop by 20-30%, something like that, you might just click that sell button, which is not what you want to do as a long-term investor. That is as simple as I can make it without going into all the maths and all the research and everything like that. Maybe in the future I'll do a bit more of a detailed version of this, but right now you need to know that these index funds are the best way for you to invest. I have a few ETFs right here, FTSE 100, S&P 500, All World, and my favorite one at the moment is the Invesco High Dividend Low Volatility. I will be doing an ETF post on April the 6th when I buy my first ETFs in my ISA. This Invesco one will have a good explanation in it, and you'll see why I like it. That's all from me today. Hopefully that just helps you choose which funds you're going to do. Managed funds really suck. Index funds are right where it's at. And ETFs are good for tradability, particularly on the Trading 212 app. As usual, if you found this video interesting, please like and subscribe. There's also the Trading 212 app link in my description. If you sign up to that and book in with some new ETFs, you'll get a free share. I'll get a free share. And hopefully this is just enough explanation for you to start investing.